In this chapter, we will discuss the auditor's responsibility to assess the risk of fraud and to detect material misstatements due to fraud, to describe major areas of fraud risk, and to discuss the audit procedures the auditor uses to detect fraud. At the end of Chapter 10, you should be able to do the following. You should be able to define fraud and distinguish between fraudulent financial reporting and misappropriation of assets. Be able to describe the fraud triangle and identify conditions for fraud. Understand the auditor's responsibility for assessing the risk of fraud and detecting material misstatements due to fraud. Identify corporate governance and other control environment factors that reduce fraud risk. At the end of Chapter 10, you should also be able to develop responses to identified fraud risks, recognize specific fraud risk areas, and develop procedures to detect fraud. Understand interview techniques and other activities after fraud is suspected. And lastly, be able to describe information about the fraud risk assessment that must be documented in the working papers. Let us begin by defining fraud. Distinguish between fraudulent financial reporting and misappropriation of assets. Fraudulent financial reporting is an intentional misstatement or omission of amounts or disclosures with the intent to deceive the users of the financial statement. Most cases involve an attempt to overstate income, but can also involve the understatement of earnings of the entity. Earnings management involves fraud or deliberate actions taken by management to meet the company's earning goals. Income smoothing is a form of earnings management in which revenues and expenses are shifted between periods to reduce fluctuations in earnings. In contrast, a misappropriation of assets is fraud that involves the theft of an entity's assets. The term misappropriation of assets is normally used to refer to theft involving the company's employees and other individuals internal to the organization. Misappropriation of assets is normally perpetrated at lower levels of the organization hierarchy. In some notable cases, however, it has been found that top management could get involved in the theft of the company's assets as well. Moving on, we will now discuss the fraud triangle and identify conditions for fraud. The three conditions for fraud arising from fraudulent financial reporting and misappropriation of assets are referred to as the fraud triangle. The three conditions are incentives or pressures, opportunities, and attitudes or rationalization of the individual. Management or other employees have incentives or pressures to commit fraud. Circumstances provide opportunities for management or employees to be dishonest. An attitude or character or set of ethical values exists that allows management or employees to commit fraud, or they are in an environment that imposes sufficient pressure that causes them to rationalize committing a dishonest act. In here, we have an illustration of the three conditions for fraud, also referred to as the fraud triangle. You can find figure 10-1 on page 299 of your textbook. An essential consideration by the auditor in uncovering fraud is identifying factors that increase the risk of fraud. Table 10-1 provide examples of these fraud risk factors. A common incentive for companies to manipulate financial statements is a decline in the company's financial prospects. For example, companies may manipulate earnings to meet debt covenant restrictions or requirements. Opportunities for manipulation also exist greatly for companies in industries where significant judgments and estimates are involved. For example, a turnover in accounting personnel or the existence of other deficiencies in accounting and information processes can create an opportunity for misstatement. The attitude of top management toward financial reporting is a critical risk factor in assessing the likelihood of fraudulent financial statements. An example would be management's practice of making overly aggressive or unrealistic forecasts to analysts, creditors, and other third parties. You can find Table 10-1 on page 300 of your textbook. The same three conditions, which are incentive or pressures, opportunities, and attitude or rationalization, also apply to misappropriation of assets. However, in assessing risk factors, greater emphasis is placed on individual incentives and opportunities for theft. Examples of fraud risk factors for each of the three conditions for misappropriation of assets are provided in Table 10-2 on page 302 of your textbook. In here, we have an illustration of the most commonly cited fraud risk conditions. As you can observe from this figure, the incentive or pressure to seek personal financial gain to fund extravagant lifestyle or not to make ends meet, the opportunity due to a company's weak internal controls, and the attitude of management where executives feel a sense of superiority are the critical risk factors or conditions related to fraud. You can find figure 10-2 on page 301 of your textbook. Figure 10-3 summarizes the profile of the fraud perpetrators in 348 actual fraud cases examined by KPMG. The characteristics are based on age, gender, time at organization, the employee's rank in the organization, where the perpetrator works, whether the perpetrator was employed by the organization, and the type of fraud committed by the employee. In this figure, you can observe that collusion with others has the highest percentage when fraud was committed. Also, 90% of the perpetrator of fraud in this illustration were employed by the organization. You can find figure 10-3 on page 301 of your textbook. Table 10-2 provides examples of risk factors for each of the three conditions of fraud for misappropriation of assets. Financial pressures are a common incentive for employees who commit misappropriation of assets. Employees with excessive financial obligations may steal to meet their needs. Opportunities for theft exist in all companies. For example, opportunities are greater in companies with accessible cash or with inventory or other valuable assets, especially if the assets are small or easily removed. Weak internal controls also create opportunities for theft. Management's attitude toward controls and ethical conduct may allow employees and managers to rationalize theft of assets. An example would be a disregard for internal controls by management by overriding existing controls or failing to correct known internal control deficiencies. You can find Table 10-2 on page 302 of your textbook. We will now discuss the auditor's responsibility for assessing the risk of fraud and detecting material misstatements due to fraud. Auditing standards require the auditor to assess the risk of material misstatement due to fraud, and those standards provide guidance to assist the auditor in making that assessment. The auditing standards require that the auditor plan and perform the audit with an attitude of professional skepticism. The two components involved are the auditor's ability to have a questioning mind and the auditor's critical evaluation of audit evidence. Auditing standards emphasize consideration of a client's susceptibility to fraud regardless of the auditor's beliefs about the likelihood of fraud and management's honesty and integrity. The audit engagement team should evaluate the reasons for material misstatement, determine whether it was intentional or an act of fraud, and to consider whether other such misstatements are likely to have occurred. Auditing standards require the audit team to conduct discussions to address how and where the entity's financial statements might be susceptible to material misstatement due to fraud, how management could perpetrate and conceal fraudulent financial reporting, how anyone might misappropriate assets of the entity, and how the auditor might respond to the susceptibility of material misstatements due to fraud. Auditing standards also require that the auditor make specific inquiries of management about fraud in every audit. Auditing standards require the auditor to evaluate whether fraud risk factors indicate incentives or pressures to perpetrate fraud, opportunities to carry out fraud, or attitudes or rationalization are used to justify a fraudulent action. Auditors must perform analytical procedures to help identify unusual transactions or events that might indicate the presence of material misstatements in the financial statements. In addition to the ratio analysis performed as part of preliminary analytical procedures, the auditor may perform horizontal and vertical analysis of the financial statements. In horizontal analysis, the account balance is compared to the previous period and the percentage change in the account balances for the period is calculated. In contrast, vertical analysis is one where the financial statement numbers are converted to percentages. The auditors should also consider all other information they have obtained in any phase or part of the audit as they assess the risk of fraud. For example, information about management's integrity and honesty obtained during client acceptance procedures. Figure 10-4 summarizes the information used to assess fraud risk. The 5 sources of information, which are communication among audit teams, inquiries of management, risk factors, analytical procedures, and other information, are seen on the top of the figure. We have just discussed these 5 sources of information. You can find figure 10-4 on page 304 of your textbook. Figure 10-5 is an example of horizontal analysis applied to the condensed income statement for Hillsburg Hardware. For example, in this figure, we can observe that sales increased by 11,860 from the prior year, which represents a 9% increase in the value of the company's sales. The objective of using horizontal analysis in this particular example was to identify unusual or unexpected relationships involving revenue accounts that may indicate fraudulent financial reporting. You can find figure 10-5 on page 306 of your textbook. Auditors evaluate all of the sources of information to assess the risk of material misstatements due to fraud as part of the audit planning. This assessment continues throughout the audit because the auditor may learn new information while performing audit procedures. Now, auditing standards require that the auditor presume there is a risk of fraud in revenue recognition. If the auditor concludes that this assumption related to revenue recognition does not apply, then the auditor must document this conclusion in the working papers. The next topic we will cover in this chapter will be about corporate governance and other control environment factors that reduce fraud risk. Management is responsible for implementing corporate governance and control procedures to minimize the risk of fraud through a combination of prevention, deterrence, and detection measures. The American Institute of Certified Public Accountant identifies 3 elements to prevent, deter, and detect fraud. These elements are the culture of honesty and high ethics, management's responsibility to evaluate risk of fraud, and the Audit Committee's oversight of the entity. The most effective way to prevent and deter fraud is to implement anti-fraud programs and controls that are based on core values embraced by the company. Honesty and integrity by management reinforces honesty and integrity by employees. Wrongdoing occurs less frequently when employees have positive feelings about their employer than when they feel abused, threatened, or ignored. To prevent fraud, companies must implement screening policies and promote employees who are trustworthy. In here, we have an example of the key contents of an effective code of conduct, which are the organizational code of conduct by the entity, the general employee conduct, the conflicts of interest. All employees share a responsibility for the organization's public relations, relationships with clients and suppliers. Employees must not accept entertainment, gifts, or personal favors that may appear to influence business decisions in favor of any person with whom the organization has business dealings. Employees may not receive kickbacks and secret commissions. Employees who have access to organization funds must follow prescribed procedures. Employees responsible for record keeping and accounting must not engage in any false record or communication. Employees must take care to separate their personal roles from their organizational positions. All employees must make every effort to achieve a complete and accurate and timely communications. And lastly, employees must handle financial and personal information about customers and others with whom the organization has dealings with by collecting, using, and retaining only the information necessary for the organization's business. You can find Table 10-3 on page 308 of your textbook. New employees should be trained about the company's expectations of employees' ethical behavior. Fraud awareness training should also be included whenever an employee joins the company. Employees should periodically confirm their responsibilities for complying with the code of conduct within the organization. Employees must know that they will be held accountable for failure to follow the code of conduct. Enforcement of violations of the code sends the message that compliance with the code is expected for every employee within the organization. Effective fraud oversight begins with management recognition that fraud is possible and almost any employee is capable of the behavior or the act of committing fraud. Management is responsible for implementing internal controls to mitigate fraud risks within the organization. For example, management can outsource certain operations such as transferring cash collections from company personnel to a bank lockback systems. Management should periodically evaluate anti-fraud programs within the entity and ensure that internal controls are effective. The internal audit function within an entity also plays a key role in monitoring activities to ensure that anti-fraud programs and controls are operating effectively for the organization. Figure 10-6, as seen in here, reflects the percentage of reduction in losses from and the duration of fraud that occurred as a result of anti-fraud controls such as the company's anti-fraud policy, the code of conduct that has been established, a dedicated fraud department within the organization, the fraud training for employees, a hotline, the management review, the proactive data monitoring and analysis, and lastly, the performance of unexpected or surprise audits. You can find figure 10-6 on page 310 of your textbook. The Audit Committee has the primary responsibility to oversee the organization's financial reporting and internal control process. The Audit Committee is a deterrent to fraud by senior management by directing reporting of key findings by internal auditors to the Audit Committee, periodic reports by ethics officers about whistleblowing, and other reports about the lack of ethical behavior or suspected fraud within the organization. Because the Audit Committee plays an important role in overseeing the actions of management, the Public Company Accounting Oversight Board auditing standards require that the auditor of a public company to evaluate the effectiveness of the board and the Audit Committee as part of the auditor's evaluation of the operating effectiveness of internal control over financial reporting. As illustrated here in figure 10-7, the Audit Committee is ultimately accountable for mitigating the risk of fraud within the organization. You can find figure 10-7 on page 311 of your textbook. Moving on, we will now discuss the auditor's responses to identified fraud risks. When an auditor identifies risks of material misstatements due to fraud, the auditor develops responses at 3 levels: the overall response level, the response at the assertion level, and responses related to management override of internal controls. An overall response to the risk of fraud is to assign more experienced personnel to the audit or to bring in a fraud specialist within the audit engagement. When the auditor identifies risks at the assertion level, the auditor's response may involve changing the nature, timing, and extent of audit procedures. To address the risk of management override of internal controls, 3 procedures must be performed by the auditor in every audit. These procedures are to examine journal entries and other adjustments for evidence of possible misstatements due to fraud, the review of accounting estimates for biases, and to evaluate the business rationale for significant unusual transactions. The auditor's assessment of risk of material misstatement due to fraud is ongoing throughout the audit. The auditor should be alert for discrepancies in the accounting records, conflicting or missing audit evidence, problematic or unusual relationships between the auditor and management, the results from substantive or final review stage analytical procedures that indicate a previously unrecognized fraud risk, and lastly, responses to inquiries made throughout the audit that are vague or implausible or that produce evidence that is inconsistent with other information. In the next slides, we will cover specific fraud risk areas and procedures to detect fraud. The Committee of Sponsoring Organization, or COSO as it is known, found that more than half of financial statement frauds involve revenue and accounts receivable and related cash. The three main types of revenue manipulation are fictitious revenues, premature revenue recognition, and manipulation of adjustments to revenue. Many potential warning signals or symptoms indicate revenue fraud. Two of the most useful are analytical procedures and documentary discrepancies. Although misappropriation of cash receipts is rarely as material as fraudulent financial reporting of revenues, such fraud can be costly to the organization because of the direct loss of assets or cash. Misappropriation of assets usually involve the failure to record a sale or the theft of cash receipts after a sale is recorded. The failure to record a sale is one of the most difficult types of fraud to detect. Such frauds are easier to detect when goods are shipped on credit to customers. It is much more difficult to hide the theft of cash receipts after a sale is recorded because the perpetrator must reduce the customer's account in one of three ways. The perpetrator must record a sales return or allowance, write off the customer's account, or to apply the payment from another customer to the customer's account. Analytical procedures and comparisons are helpful in detecting fraud involving revenue. Table 10-4 is an example of the effect of fictitious receivables on accounting ratios based on Regina Vacuum Company. It includes comparative sales, cost of sales, and accounts receivable data for Regina Vacuum, including the year before the fraud and the two identified fraud year. Notice how both a higher gross profit percentage and a lower accounts receivable turnover ratio in the most recent 2 years that include the fraud help signal fictitious accounts receivable. You can find Table 10-4 on page 315 of your textbook. Fictitious inventory has been at the center of several major cases of fraudulent financial reporting. The auditors are required to verify the existence of physical inventories in audit, but audit testing is done on a sample basis. If inventory is stored in several locations of the organization, it is relatively easy for the client to move inventory to the sample testing site. Well, analytical procedures, especially gross profit margin percentage and inventory turnover, are effective in detecting fraud involving inventory. Table 10-5 is an example of the effect of fictitious inventory on inventory turnover based on Crazy Eddie Inc. Notice in here that the gross profit percentage did not signal the existence of fictitious inventories, but the significant decrease in inventory turnover was a sign of fictitious inventory. You can find Table 10-5 on page 317 of your textbook. Companies may deliberately attempt to understate accounts payable and overstate income. The most common fraud in the acquisition area is for payments to be issued to fictitious vendors and depositing the cash in fictitious accounts. The other areas of fraud risk involve fixed assets, such as when companies capitalize repairs to increase the amount of assets on the balance sheet. When the values of intangible assets, especially goodwill, are based on estimates, the risk of fraud increases due to susceptibility to manipulation. Payroll expense is rarely a significant risk area for fraudulent financial reporting, but payroll fraud is common, such as payments made to fictitious employees or the overstatement of payroll hours. The next topic we will cover is the auditor's responsibilities when fraud is suspected. Frauds are often detected through anonymous tips, management review, internal audit, or by accident. The auditors continually evaluate the evidence gathered for indication of material misstatement due to fraud throughout the duration of the audit. When fraud is suspected, the auditor gathers additional information to determine whether fraud actually exists. Figure 10-8 highlights the most common fraud detection methods. In here, you will observe that tips is the most frequent method of fraud detection, followed by management review and internal audit. External auditors detect a relatively small percentage of fraud, but are more likely to detect fraud when it materially impacts the financial statements. You can find figure 10-8 on page 319 of your textbook. When fraud is suspected, the auditor may use inquiry to determine whether fraud actually exists. Inquiry is an effective method of gathering more information and may take the form of informational inquiry, assessment inquiry, or interrogative inquiry. An auditor uses informational inquiry to obtain information about facts and details that the auditor does not have, usually about past or current events or processes. Assessment inquiry is used by the auditor to corroborate or contradict prior information. Interrogative inquiry is often used to determine if the individual is being deceptive or purposefully omitting disclosure of key knowledge of facts, events, or circumstances. For inquiry to be effective, the auditor must be skilled in evaluating responses to inquiry, must have effective listening skills, and must have the ability to observe behavioral cues. Table 10-6 outlines verbal cues that the auditor must observe during an inquiry. Verbal cues may indicate the responder's nervousness, lack of knowledge, or even an act of deceit. In addition to observing verbal cues, The use of inquiry allows the auditor to observe nonverbal behaviors. You can find Table 10-6 on page 321 of your textbook. Table 10-7 outlines nonverbal cues that the auditor must observe during an inquiry. Expert investigators note that subjects who are uncomfortable providing a response to an inquiry often exhibit many of the nonverbal behaviors shown in this table. Of course, do keep in mind, not everyone who exhibits these behaviors is uncomfortable responding to the auditor's inquiry. The key is to identify when the individual's behavior begins to change from his or her normal behavior. Less experienced auditors should be cautious when they start to observe unusual behaviors whenever they are inquiring of a client, and they should discuss their concerns with senior members of the audit team before doing anything in response to those behaviors. You can find Table 10-7 on page 321 of your textbook. Besides inquiry, the auditor may use audit software analysis, expanded substantive testing, and consider other audit implications to determine whether fraud actually exists. Examples of audit software an auditor may use include ACL or IDEA. In expanded substantive testing, the auditor, for example, has assessed a risk that sales terms may have been altered to prematurely record revenues. The auditor, in this case, may then modify the accounts receivable confirmation request to obtain more detailed responses from customers about specific terms of the transactions, such as payment, transfer of custody, and return policy terms. Auditing standards require the auditor to consider the implications for other aspects of the audit. When the auditor determines that fraud may be present, the auditing standards require the auditor to discuss the matter and audit approach for further investigation with an appropriate level of management, even if the matter might be considered inconsequential. The appropriate level of management should be at least one level above those involved, as well as senior management and the audit committee. If the auditor believes that senior management may be involved in the fraud, the auditor should discuss the matter directly with the audit committee. Moving on, we will now discuss on the next slide documenting the fraud assessment. Auditors must document matters related to consideration of material misstatements due to fraud, such as the significant decisions made during the discussion among engagement team in planning the audit, the procedures performed to obtain information necessary to identify and assess the risk of material fraud, the specific risks of material fraud that were identified at both the overall financial statement level and assertion level, and the auditor's response to those risks. The reasons supporting a conclusion that there is not a significant risk of material improper revenue recognition. Auditors must also document the results of procedures performed to address the risk of management override of internal controls. other conditions and analytical relationships indicating that additional auditing procedures or other responses were required, and the actions taken by the auditor related to the response. And lastly, the nature of communications about fraud made to management, the audit committee, or others involved with the audit. We have reached the end of the discussions for Chapter 10. In this chapter, we cover the types of fraud, assessing the risk of fraud, methods used to gather evidence through inquiry and analytical procedures, and lastly, documenting the fraud assessment. Please complete the required evaluation method for Chapter 10 as it will be part of your final grade. The comprehensive problem is to be submitted on the specified due date. Please use the comprehensive problem module in Blackboard for instructions and requirements. You have reached the end of the course presentation for Chapter 10. Please access the video for Chapter 11 for the next presentation of the course.